Assalamualaikum and hi, we are from Group 9 and my name is Nur ANISHAH binti Shah with the matric number 292878. So this project explores the fundamental of portfolio management by applying modern portfolio theory or MPT. The theory emphasizes diversification as a way to reduce risk while aiming to achieve optimal returns. We began with an initial capital of 500,000 and constructed a diversified portfolio made up of the 5 Malaysian stocks. This include FNN from the consumer goods sector, Telekom Malaysia in the telecommunications, Ramsol from the technology sectors, Kosan in the healthcare, and Samdabri property in the real estate. To further enhance diversification, we added Microsoft Corporation as our international equity exposure and included the Kenanga Conservative Fund as a fixed income asset to reduce overall portfolio volatility. The portfolio management process was carried out in the 3 phases. First, we built the initial portfolio. Then we conducted the first rebalancing by introducing fixed income investment. And finally, we carried out the second rebalancing by adding an international stock. Rebalancing was crucial in helping us maintain our desired asset mix and management risk, particularly during volatile market conditions. Throughout the project, we simulated real-world investment strategy using actual market data. We assess our portfolio's performance through key indicators such as returns, risk analysis, and benchmarking.
Hi and Assalamualaikum. My name is Nur OSNIZAN and my matric number is 292829. Let's begin by understanding the global and local economic backdrop in the first half of 2025. Globally, growth slightly declined to 3.3% and inflation cooled to 4.1%, a significant improvement from over 8% during the pandemic. Central banks react differently. While the Eurozone began easing, the US and UK maintained strict monetary policy. Geopolitical tensions flared in May when the US launched airstrikes on Iran, pushing oil prices to $80 per barrel and shaking energy markets. Despite this, the tech sector stays strong, driven by artificial intelligence and cloud computing. In Malaysia, the economy remains stable. GDP is projected to grow up to 5% with inflation under control. Bank Negara maintained the OPR at 3% and the ringgit stay within a healthy range. Export, especially from the E&E sector, play a big role in the supporting groups. From a policy standpoint, Malaysia's 2025 national budget aligns with Economy Madani framework, emphasizing inclusive and sustainable growth. The government prioritized digitalizations with massive investment in 5G infrastructure. Additionally, support from small and medium enterprises is key to boosting employment and productivity. A major thrust is also given to green technology and energy transitions, aligning with global ESG standards and attracting long-term responsible investment. Based on early 2025 economic stability, we launched the portfolio on January 2nd with a focus on strategic diversification. Locally, we invested in consumer, telecommunication, technology, and healthcare sectors, all resilient in nature. To capture global innovation trends, we included Microsoft for its strong AI and cloud computing exposure. For risk management, we allocated part of the funds to the Kenanga Conservative Fund, ensuring steady returns and capital preservations. 2 major rebalancing actions were taken. The first, on May 4th, responded to oil price hikes and geopolitical risks. We shift part of the portfolio to government bonds and real estate for stability and reduced market exposure. The second one, on June 1st, came as optimism returned to the tech sector. We increased our Microsoft holdings and added the MSCI World ETF for global diversification. Through both phases, we maintain a balance between growth asset and safe instrument to protect capital. In conclusions, our portfolio was actively adjusted to navigate the volatile global landscape. By diversifying across industries and geographies and also balancing growth with security, we align our investment strategy with both domestic priorities and global market dynamics.
Hi and Assalamualaikum. My name is Muhammad AMIRUL bin Muhammad FADZIL and my matric number is 294643. Let's continue with industry analysis. We have selected a diversified mix of industry to capture both growth potential and stability. Starting with consumer sector, we analyze Fraser and Neve Holdings. This is a defensive industry with stable demand during economic downturns. FNN is adapting well by offering healthier options and expanding export to Asia and the Middle East, though it faces margin pressure due to rising costs and currency fluctuations. Next, in telecommunications, Telekom Malaysia plays a key national role under the general initiatives. It's leading Malaysia's digital rollout, especially with 5G and cloud services. Although the industry requires heavy investment and faces intense competitions, TM's early move into fiber and enterprise services gives it a strong advantage. In the technology sector, we selected Ramsol Group, a growing HR tech company. Unlike hardware firms, it provides scalable cloud-based solutions for workforce management, supported by digital transformation policies like My Digital. Ramsol's asset-light model and regional expansion make it a promising growth player. In healthcare, Kosan Rubber is a major glove manufacturer. Demand has normalized after COVID, but long-term prospects remain solid due to ongoing global healthcare needs. Kosan is shifting towards higher margin, especially glove and automations to stay competitive. Moving to property, SMW Property is seeing recovery, especially in industrial and affordable housing. Supportive government policies and push for eco-friendly developments are driving growth. Its diversified portfolio helps cushion against market volatility. In AI intelligence, we selected Microsoft Corporations. It is a global leader thanks to its integrations of AI into everyday software like Word, Excel, and more. AI offers huge potential but come with regulatory and ethical challenges. With Microsoft balances innovation with strong established revenue streams. Finally, for fixed income, the Kenanga Conservative Funds give our portfolio stability. It invests in Malaysia government bonds and high-grade corporate debt. With interest rates stabilizing, these funds help reduce risk and act as hedge during stock market downturns. Overall, our selection blends stable income, high growth, and digital transformation, all aligned with Malaysia's economic direction and global trends. Thank you.
I will be talking about fundamental and stock analysis. There are in total 5 key performance indexes used in this analysis. The first one is net profit margin. Net profit margin is a financial metric that shows the percentage of profit a company makes from its total revenue after all expenses are deducted. The second is earnings per share (EPS). Earnings per share is a key financial metric that shows how much profit a company earns for each share of its outstanding common stock. The third index is return on equity. Return on equity is a financial ratio that measures how effectively a company uses its shareholders' equity to generate profit. The fourth is price to earnings ratio, PE ratio. The PE ratio is a valuation metric that shows how much investors are willing to pay for a company's earnings. The final one is market to book ratio or MB ratio. The market to book ratio compares a company's current market value to its book value. It's used to evaluate whether a stock is undervalued or overvalued. Next, I will be talking about stock analysis for each of our selected stocks. The first one is FNN. They reached a 10.52 net profit margin, a 1 ringgit 40 cent earnings per share, a 14.2% return on equity, a 20.27 PE ratio, a 2.75 MB ratio. Next up is TM Berhad. They reached 14.07% net profit margin, a 52-cent earnings per share, a 21.06% return on equity, a 14.41 PE ratio, a 2.59 market to book ratio. Next up is Renso Group Berhad. They reached 32.25 net profit margin percentage. They only have 4 cent earnings per share, and they reached 15.53% return on equity and 18.12 PE ratio, a 2.66 market to book ratio. As for Kosan Rubber Industries, they reached a net profit margin of 7.32% and earnings per share of 0.05 ringgit, a return on equity of 3.29%, a 32.64 price to earning ratio, and a 1.09 market to book ratio. Next up for Sam Dhabi Property Berhad, they reached 13.59 net profit margin percentage. They have 7 cents earnings per share. They have 4.9% return on equity. They also reached 17.36 PE ratio. They also have 0.91 market to book ratio. Next up is Microsoft Corporation. They have 36.86 net profit margin percentage. They recorded 14.67 earnings per share. They have 33.61% return on equity. They have 37.11 price to earning ratio and a 10.97 for their market to book ratio. The final one is Kenanga Conservative Fund. They recorded 6.57% net profit margin, a 0.1111 which is 11 cents earnings per share, and then 7.77 return on equity percentage. They also recorded 7.9 price to earnings ratio and a 0.6 market to book ratio. Next up, we'll be talking about the analysis for the KPI. First one is F&N Holdings Berhad. As of 1st June 2025, F&N Holdings Berhad demonstrates strong financial performance, making it a compelling addition to an investment portfolio. The company's stock is priced at 27.34 ringgit and backed by solid key performance indicators. F&N has a net profit margin of 10.52%, meaning it earns 11 cents in profit for every 1 ringgit of sales. Its earnings per share EPS stands at 1 ringgit 40 cents, indicating good profitability for shareholders. Furthermore, F&N records a return on equity of 14.20%, reflecting effective use of shareholders' funds. With a price to earning ratio PE ratio of 20.27, investors are willing to pay 20.27 ringgit for every 1 ringgit of earnings, showing market confidence in the company's future growth. The market to book ratio of 2.75 suggests that the stock is valued nearly 3 times above its book value, further signaling strong investment trust in F&N's asset base. Overall, F&N consistent stock performance and solid financial ratios support its inclusion in a well-balanced investment portfolio. The second is TM Berhad. As of 1st June 2025, TM Berhad stock is trading at 58 cents and shows strong performance indicators, making it an attractive investment. The company has a net profit margin of 14.07%, reflecting solid profitability with 14 cents earned for every 1 ringgit in sales. TM's EPS stands at 52 cents, which is average within its industry, offering a reliable benchmark for investors. More notably, TM Berhad boasts a high return on equity of 21%, indicating exceptional efficiency in using shareholders' equity to generate profit. This strong ROE is a key factor in its selection for the investment portfolio. The price to earnings PE ratio of 14.41 shows that investors are willing to pay 14 ringgit and 41 cents for every 1 ringgit of earnings, suggesting fair market confidence. The MBE ratio of 2.59 further implies that the stock is valued significantly above its book value, reflecting strong investors' trust in TM's future growth. Overall, TM Berhad's excellent ROE, reasonable stock price, and consistent financial performance position it as a promising investment with a potential for solid return. The third is Renso Group Berhad. As of 1st June 2025, Renso Group Berhad is trading at 88 cents and demonstrates a mix of strong profitability and modest shareholder return. The company reports an impressive net profit margin of 32.25%, meaning it earns 32 cents for every ringgit in sales, highlighting a highly profitable business model. However, its EPS only 4 cents, which may be considered low and less attractive to many investors. Ramsor also records a return on equity of 15.53%, indicating solid efficiency in generating returns on shareholder investment. Its P/E ratio of 18.12 suggests that investors are willing to pay 18.12 ringgit for every 1 ringgit of earnings, reflecting confidence in its future performance. Additionally, the NB ratio stands at 2.66, which shows that investors value the company at more than twice its book value, another sign of strong investor trust. Despite the low EPS, Rensol's high profit margin and solid ROE justify its inclusion in the portfolio. These indicators suggest a scalable and profitable business, making it a promising long-term investment. The fourth is Kosan Rubber Industry. As of 1st June 2025, Kosan Rubber Industry Berhad its stocks is priced at 1 ringgit 66 cents. The company shows a net profit margin of 7.32%, meaning it generates 7 cents profit for every 1 ringgit of sales, while its earnings per share is 5 cents, indicating modest earnings for shareholders. In terms of efficiency, Kosan Rubber Industry return on equity is relatively low at 3.29%, suggesting less effective use of shareholders' equity to generate profit. However, its price to earnings ratio is high at 32.64%, reflecting strong investor expectation for future growth, as investors are willing to pay 32 ringgit and 64 cents for every 1 ringgit of earning. The market to book ratio is 1.09, indicating that investors value the stock slightly above its book value despite the low ROE. Kosan Rubber is included in the portfolio because its high PE ratio suggests it is a fast-growing stock with significant potential for value appreciation. The fifth one is Saidami Property Berhad. As of 1st June 2025, Saidami Property Berhad stock price stands at 1 ringgit and 44 cents. The company records a strong profit margin of 13.59%, indicating it retains a significant portion of its revenue as profit, which is attractive to investors. However, its EPS is relatively low at 7 cents, possibly due to high demand driving up the share price. Saidami Property Berhad also shows an ROE of 4.9%, reflecting efficient use of equity to generate profit. With 5 cents earned for every 1 ringgit of equity invested, the PE ratio of 17.36 suggests investors are willing to pay 17 ringgit for every 1 ringgit of earnings, indicating positive market sentiment. On the other hand, the NB ratio is 0.91, slightly below 1, meaning the stock is valued just below its book value. Overall, Sundabe Properties Berhad consistent performance key metrics despite the lower NB ratio justify its inclusion in the portfolio as a relatively safe and stable investment. The sixth one is Microsoft Corporation. As of 1st June 2025, Microsoft Corporation stock is priced at 1,959 ringgit, reflecting its status as highly valuable company. Microsoft shows an impressive net profit margin of 37%, meaning it generates 37 cents in net profit for every 1 ringgit of revenue, demonstrating exceptional profitability. Its earnings per share is also strong at 14 ringgit per share, offering attractive returns to shareholders. The company boasts a remarkable ROE of 33%, indicating it earns 34 cents for every 1 ringgit of the equity invested, showcasing excellent management efficiency. The PE ratio is standing at 37.11, meaning investors are willing to pay 37 ringgit for each 1 ringgit of earnings, reflecting high market confidence. Additionally, Microsoft market to book ratio is 10.97, showing the stock trades at nearly 11 times its book value, signaling strong investor trust in its assets and growth potential. Microsoft is included in the portfolio due to outstanding financial performance, top-tier credit rating, which is AAA rated by S&P 500, and reputation as a low-risk investment with guaranteed high returns, making it one of the best-performing stocks globally. The final one is Kenanga Conservative Fund. As of 1st June 2025, Kenanga Investment Bank Berhad stock price was 91 cents. The company recorded a net profit margin of 6.57, indicating of 0.57%, indicating it earns about 60 cents profit for every 1 ringgit of sales. Its earnings per share is 11 cents, meaning shareholders receive 11 cents per share held. Kenanga shows a return on equity of 7.77%, suggesting it generates 78 cents of profit for every 1 ringgit of equity, reflecting moderate efficiency in using equity to generate return. The PE ratio stands at 7.9, indicating investors are willing to pay about 8 ringgit for every 1 ringgit of earnings. However, the market to book ratio is relatively low at 0.6, meaning the stock is priced below its book value, which might suggest undervaluation or market caution. Kenanga Investment Bank is included in the portfolio due to its solid PE and ROE ratio, highlighting its potential to provide attractive return on investment despite the modest stock price.
Assalamualaikum. My name is Muhammad bin ZAHIR. My metric number is 294707. Today I would like to present about database for selected stock and securities. For the first one is initial portfolio. On 2 January 2025, we launched our portfolio with 5 carefully selected companies listed on Bursa Malaysia. Each company represents a different sectors, and the aim was to construct a portfolio that is diversified, balanced, and resilient to sector-specific shocks. The 5 stocks were FNM, 28.18 ringgit for the consumer product sector; Kosa Rubber Industry, 2.78 ringgit for the healthcare sector; Ramsol Group, 0.73 ringgit for technology and HR; Saindabi Property, 1.63 ringgit for property development sector; and the last one for the TM, 6.77 ringgit for telecommunication sector. This selection was not only based on sector but also on company size. FNN, MTN are established large cap companies with relatively stable performance, while Ramsol and Saindabi Property represent smaller cap stock with higher potential growth but greater volatility. Kosa sit in the mid-cap category, providing a balance between risk and return. The main objective at this stage was to build a strong foundation for long-term performance by reducing unsystematic risk. By selecting companies from unrelated industry, we lowered the chances of one event negatively impacting the entire portfolio. The diversity in company size allows us to enjoy the stability of large firms while still capturing the upside potential of smaller companies. This initial structure allows the portfolio to remain relatively stable even when certain sectors underperform. Since all assets were denominated in Malaysia ringgit, the analysis remains simple, focusing purely on price movement and company performance within Malaysia. After observing the portfolio progress over several months, we execute our first rebalancing on 5 May 2025. This was done to increase sectoral exposure and optimize potential return. The new stock added was Kenanga Investment Bank Berhad, 0.664 ringgit for the financial services. The decision to include financial institution was based on the view that the financial sector play a central role in Malaysia's economic activity and has long-term growth potential. Financial stocks also tend to perform well in economic recovery phases and can serve as a hedge against inflation due to their interest income structure. We maintain a diversified composition while staying within the local currency environment, avoiding the added complexity of exchange rate risk. We were better positioned to manage fluctuation in any particular industry while maintaining access to steady performance. It also showed that the portfolio was being actively monitored and improved, not just passively held. On 3 June 2025, we added an international stock to the portfolio for the first time, Microsoft Corporation. Entry price 1,965.31 cents converted from USD. Microsoft is one of the world's largest technology companies with consistent revenue streams, strong innovation, and global dominance. Including Microsoft allow us to tap into global technology sector which offers strong growth potential and is often resilient during economic uncertainty. We wanted to expand the portfolio beyond Malaysia to reduce country-specific risk and benefit from global economic growth, especially in the tech sector. The portfolio now included a foreign-dominated asset, which is USD, which introduced currency risk for the first time.
Hi, Assalamualaikum. My name is HAIKAL FADZIL, number 2944786. Now I'll present about return and tracking. In the initial portfolio, performance showed a wide variation across selected stocks, such as Kosan, Ramsul, Telecom, Malaysia, Fraser and Neave, and Sandabi. The Kosan rubber industry recorded a sharp actual return of negative 32%, well below its expected return of 6.2%, and was categorized as underperformed with poor tracking accuracy. Similarly, Samdabi property underperformed significantly with an actual return of negative 19% versus an expected return of 7%. Also with poor accuracy, in contrast, Ramsul Group stood out with an actual return of 17.81%, well above the expected return of 7%, resulting in outperform against KLCI. TM showed a modest actual return of 1.77% against an expected return of 5%, slightly maintained performance with KLCI's. Fraser and Neave recorded an actual return of negative 4.54% and yet still outperformed the KLCI with moderate tracking accuracy. For the first rebalancing, adjustment led to better portfolio balance with the introduce of Kenanga Positive Fund in fixed income. It produced a stable actual return of 0.75% against expected return of 2.57%, a bit underperformance but still outperformed KLCI. For Ramsul Group continued to perform well, achieving an actual return of 1.14% compared to negative expected return of negative 1.27%. With TM, however, posted an actual return of negative 4.3%, underperformed against KLCI, even though its expected return is positive, but the actual is negative. For the FNN, showed a positive shift with 1.19% actual return, maintaining good accuracy and outperformance. And for Sandabi property, improved with an actual of 3.7%, even though its expected return of negative. And for the secondary balancing, performance further improved, supported by Microsoft introduced in international stock. So Kenanga Positive Fund remained steady with an actual return of 0.3% and an expected return of 1.56%, marking a moderate tracking accuracy and outperformance against KLCI. We can see that KLCI have a negative return from the initial portfolio until secondary balancing, so this is not good for our economy. Okay, now we continue for the Telecom Malaysia. Telecom Malaysia recorded a mild actual return of 0.46% negative compared to an expected return of negative 2.24%, resulting in slight underperforming but good accuracy. FNN surged to 5.63% actual return with an expected return of 0.18%, again strongly outperforming and marked by high tracking accuracy. And finally, for the Microsoft in the international stock, it has produced a solid actual return of 3.3% versus expected return of 2.99. Against KLCI, that is have negative return. But from all of this return, we still have still have we do not have any profit. So it is because the economy is not doing well in Malaysia. So that is for me. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Muhammad AZMI and my matrix number is 294757. So I want to talk about CAPM and allocation. At the beginning of our portfolio journey on January 2nd, we applied the capital asset pricing model or CAPM to estimate each stock expected return based on its beta, the risk-free rate of 3.19% and the projected market return of 5.56%. The APM helps us understand how much return we should expect from each stock given its market. Ramsol had the highest beta of 2.02, meaning it was highly sensitive to market change and showed the highest CAPM return of 7.99%. Sandabi Property follow with a beta of 1.79 and CAPM return of 7.44%. So this combination aim to balance aggressive growth with conservative stability. Thank you. So next, I want to continue with first rebalance. During our first rebalance on May 4, we update the CFM calculation using a reduced market return of 0.39365% with a risk-free rate held at 3.19%. So this lower market outlook reflected increasing global volatility and justified a more conservative shift based on their beta annual CAPM return. Most assets show declining return expectation. Sandabi, for example, now had a CAPM return of negative 3.17%, while Ramsol fell to 1.27%. In response, we significantly restructure the portfolio by allocating 96% to the Kenanga Conservative Funds. Ramsol was given a 15% long position thanks to strong past performance, while Telecom was allocated 9%. FNN and Sinabi were shorted at negative 20% and negative 1% respectively. Overall, the allocation became far more risk-averse while tactically holding Ramsol as a potential outperformer. And lastly, we focus on the second rebalancing conducted on 1st June. Market sentiment turned negative with a CAPM market return adjusted sharply to negative 4.115%. This dramatic shift caused expected return for high beta stock to drop significantly. Sime Dhabi Properties CAPM return for instance fell to negative 13.56%, while Ramsor dropped to negative 7.62%. In contrast, lower beta assets like Microsoft, which is 0.0266 beta, and Kenanga Fund still produce positive CAPM return of 2.99% and 1.56% respectively. The allocation strategy here lean heavily on capital preservation and defensive positioning. We allocated 108% of capital to the Kenanga Conservative Fund, leveraging the portfolio through borrowing due to its expected stability. Ramsor received a 17% long allocation thanks to its strong performance history, while Microsoft was introduced at 8% for international diversifications. Samdabi was dropped completely, receiving 0% weight due to its extremely negative forecast. This was our most defensive and tactical allocation yet. Thank you. So next, I want to talk about profit and loss benchmark. Despite a well-diversified allocation strategy, the initial portfolio suffered a significant net loss of 72,198 and 60 cents, reducing its value from 500,000 to 427 801.40 cents. This represents a negative 14.44% return over the period. The primary cause of this decline was poor performance from three major holdings. Kosan lost over 33,000 and failed to meet its APM benchmark of 6.29%, instead delivering an actual return of negative 32%, resulting in a massive excess return of negative 38.30%. Sanabi Property and FNN also underperformed, generating losses of 32,000 and 7,488 respectively, and missing their APM target. So the result highlight how overexposure to overvalued asset and poor directional bets can undermine otherwise sound forecasting. Next, we continue with the first rebalance of profit and loss benchmark. The outcome of this rebalancing was a modest net gain of 1,736.09%, or a portfolio return of 0.41%. This recovery was led by the Kenanga Conservative Fund, which returned 3,083.10, despite having a lower actual return than its APM benchmark, giving it an excess return of negative 1.82%. Ramsol once again outperformed expectation, returning 2.27% against a 1.27% CAPM, generating a positive excess return of 3.54%. Sandabi Property also impressed, posting an actual return of 3.70% when its CAPM expected a negative 3.17%, delivering a strong excess return of 6.87%. Telekom Malaysia was the only major drag on the portfolio, with a profit loss of 1,740.53% and excess return of negative 5.48%. So, particularly Ramsol and Sime Dabi successfully offset the losses, proving the rebalancing effort effective at cushioning the portfolio while taking advantage of outperforming equities. And lastly, we continue with the second rebalance performance of profit and loss benchmark. The portfolio suffered a net loss of 1,357.48, bringing the value down to 428,180.01%. The main reason was large loss of 6,456.32 from the short position in FNN, a stock that has unexpectedly performed well, returning 5.63% against a CAPM benchmark of only 0.18%, giving it an excess return of 4.45%. Unfortunately, our short bet worked against us. However, other assets did perform well. Ramsol delivered 2,500.69 with standout excess return of 10.99%. Microsoft added 1,064.02 with a stable excess return of 0.30%, and the Kenanga Fund contribute 1,394.08. So even short position inside the B and Telecom generated small gain due to favorable market directions. This phase revealed a key lesson why asset selection and CAPM analysis were accurate. It emphasized the importance of not only knowing what to invest in but how to position it. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is MOHAMMAD. My SHUKRI number is 294372. I'm gonna explain about asset weighted. Firstly, asset weighted is referred to how much percentage of our total investment was
allocate to each stock or asset is important, because the more weight an asset has, the more influence it has on the overall portfolio, whether it's good or bad. The first one is initial portfolio. In the initial portfolio, solver allocate the highest weight to secondary property at 33.75%, followed by Kosan at 20.72% and Telekom Malaysia at 13.27%. But interestingly, we also had negative weight or short position such as in FNN, negative 32.97%, and Kenanga Fund, negative 50.49%. This show that very aggressive and high risk setup, and unfortunately is lead to poor result. For example, Kosan and Sandabi perform very badly, dragging down the portfolio. For the first rebalancing, after seeing the losses, we rebalance. Solver recommend as much a more defensive structure, 96% in Kenanga Conservative Fund and 50% in Bensol and 9% in Telekom Malaysia. This time, it was completely removed Kosan, Senabi and Finance from the portfolio because of the poor performance, and Kenanga brought us the stability with steady return. Bensol still contributed positively. Telekom, however, continued to underperform. The last one is second rebalancing. By the second rebalancing, Solver took the defensive strategy further, with the average Kenanga to 108% increase, and increase Remsol slightly to 70%, and short the Telecom at negative 6%. Again, we avoid Kosan, FNN and Senabi completely because of their bad performance and so on. Next, Ramses remained a strong equity performer, while Kenanga give us consistent low risk return. Telecom short position give us a small gain as the stock decline.
To conclude our portfolio management project, we applied modern portfolio theory to construct and manage a diversified portfolio with an initial capital of 500,000. At first, we focused on domestic equities from key sectors like consumer goods, telecommunication, healthcare, property, and technology. As market conditions evolve, we rebalanced the portfolio twice. The first rebalancing introduced the Kenanga Conservative Fund, which helped to reduce volatility and provide capital protection. The second rebalancing added Microsoft Corporation, which giving us exposure to the international market and the growing field of artificial intelligence. We use KPAM, solver optimization, and performance indicators such as return, Sharpe ratio, and tracking error to guide our decision. These tools help to improve the portfolio overall stability and alignment with our investment goals. So in summary, this project shows how diversification, discipline, rebalancing, and data-driven strategies can turn a volatile portfolio into more stable and effective investment. It also highlighted how theoretical models like MPT can apply successfully in the real-world portfolio management. That's it from us. Thank you.